Thank you. Thank you very much, all of you, for joining us. We have a truly eminent panel of global actors and influencers here to discuss, taking some of the cues from Martin's comments, how impact can redress capitalism or help to redress capitalism. Agnes is the operating officer of the IDFC, the International Development Finance Corporation of the United States, the major player in the area of development. Gonzalo Gortazar, known to all of you who are Spanish and many in the international community, is an outstanding impact leader who is CEO of CaixaBank, which has been such a great supporter of our movement. Alison, you've just heard, after a long career at the SEC, where she was very outspoken about the need for transparency. She is now director of the International Foundation for Valuing Impacts, of which many of us here are also members, and which is a GSG initiative. And Ibukun Awosika, we didn't talk with Martin much about emerging markets, but now we want to do so, is one of the leading figures in the impact world in Africa, having been chair of the First Bank of Nigeria and involved in a number of social initiatives in Nigeria at scale. And I'd like to start with you, Alison, perhaps, by asking you, and then we will have Gonzalo, we will have Agnes, and we will have Ibukun, each spending 5 to 7 minutes, just giving us your view of how impact can help to redress some of the problems that capitalism has created for itself. Everybody happy with that? Are you all happy with that? Okay, great. So over to you, Alison.
Thank you. Thank you for having me. I'm really grateful to be part of this discussion and really to help you all celebrate the journey that GSG has been on for the last decade and many of you for much, much longer. And the journey I'm referring to is the continuing global shift toward a common understanding of how companies and those who finance them actually impact the well-being of people and planet. And that shift has progressed incrementally but steadily over time. I've watched it. And I would say arguably it starts with creating transparency and accountability around the risks and the opportunities that live outside of the traditional financial statements, that which we just heard Emmanuel speak about so eloquently. So in other words, the initial phase of the journey is a move toward just ensuring that all the risks and rewards are captured in our current disclosure regimes so that investors can accurately price risk, they can allocate capital as they see fit. That was my focus at the SEC. And I don't want to spend too much time on this kind of initial phase, but I think it's worth a quick look to think about where we've been so that as a foundation for a better understanding of where we need to go. And in my prior role as a commissioner and as acting chair of the SEC, I watched an unprecedented shift in investor understanding, that there are so many risks and opportunities related to social and environmental issues, call it ESG, that actually impact the sustainability of companies and their business models. And what I saw was an entire voluntary regime build up around disclosure of physical metrics like greenhouse gas emissions, like workforce diversity, worker safety, basic human rights issues, and more. And I saw portfolio analysts begin to incorporate this mostly voluntary information into modern portfolio theory and into traditional risk-reward modeling. I heard from analysts at some of the largest financial institutions in the world telling me that they found certain ESG-type metrics to be, in many instances, actually more predictive of long-term financial value than the information that's in financial statements. So I recognized that this voluntary regime had progressed to the point where there was a real opportunity for regulators to add value and to bring essentially 3 things to the table: consistency, comparability, and reliability. And in fact, in my view, I think that the movement had progressed to the point where regulators actually had an obligation to step in and do their part to ensure that investors that are using this data didn't end up mispricing risk and misallocating capital because of a lack of consistent, reliable information. So my colleagues and I at the SEC set about working to bring transparency and accountability to the risks and the rewards that are inherent in this new information. And in many ways, you know, we've been trying to kind of catch up in the US with the rest of the world. But now what I have learned from visionaries like Sir Ronnie and from so many folks here in this room is that I need to scale up my ambitions in the US and around the globe and help usher in what is, I think, the logical next step in this journey, and that is to add the third component to the traditional risk-reward calculus, and that component is impact. So risk-reward investment modeling, even when it's improved, I think, to capture all of the relevant risks and rewards, it still suffers from a singular focus on financial profits while ignoring the impacts that an organization has on employees, on customers, on our communities, and on the environment. So impact as a third prong of investment analysis can work within existing capitalist economies to drive meaningful improvements. Capitalism has been immensely successful in driving innovation and economic growth, but it has also rightly been criticized for exacerbating inequality and environmental degradation. But impact investing offers a method to redress some of these flaws. Impact investors know that the pursuit of profit alone can lead to certain negative consequences. Profit remains a driver, but it's not the sole one. And by focusing on not just integrating, but actually impacting social and environmental considerations, impact investors aim to harness the power of business and finance to create a more inclusive and sustainable form of capitalism. This is not a trend, it's a paradigm shift. And as I mentioned, traditional investment models often view social and environmental issues as risks to be managed, but impact investors see them for what they are, as opportunities for innovation, for value creation, and a way to unlock new markets and new opportunities by addressing pressing global challenges like clean energy, like education, like healthcare. Impact investing, I think, has the potential to drive economic growth while also keeping an eye on a different bottom line, and that's the bottom line of improving people's lives. And I use that term advisedly. It's a financial term. It refers to dollar and cents measurements, but there's a challenge, as has been mentioned earlier, in putting a dollar and cents measurement on the bottom line of improving people's lives. And that is why I feel so pleased to be part of the International Foundation for Valuing Impacts. I'm grateful to be part of that effort. They have recently put out, as you know, their first exposure draft, the General Methodology 1, which is a conceptual framework for impact accounting. It's been published for public comment, and I invite and encourage all of you to please read through this document, offer us your expertise and your guidance on how best to finalize it. This is, as we move forward together in this effort, the effort to accurately capture, evaluate, and importantly, act upon the full impact of business and finance on the global economy. I'm inspired by my fellow panelists and by Sir Ronnie and everyone here who took time out of your busy lives to be here. I hope we can work together to harness the power of capital, to address the most pressing challenges of our time and help build a more inclusive and just form of capitalism. So thank you. Thank you for having me.
Thank you. Thank you very much. Thank you very much, Alison. So, Gonzalo, if impact transparency is becoming the watershed between two paradigms, as Alison was saying, how do you see the role of banks and other financial institutions and financial markets in redressing capitalism?
Sure, thank you. And I would say we have a major role to play because we're very large. We heard Juan Bernal at the beginning talking about moving to millions to billions and then to trillions. I think large banks like ourselves can play a major role in making impact mainstream. it's a long road, no question, but we need to get going, and that's what we're doing. We actually, as CaixaBank, we see it, first of all, sort of we were born with impact in our mind. When we were born in the early 20th century, the mission of the new little saving bank in Barcelona was to help sort of low and middle class workers from work accidents and making sure that they could retire, could save for retirement in a moment where the safety net of Social Security was virtually non-existent. No? Then we've gone from very small to very big, and why should we sort of eliminate the concept of impact as part of our driving force? And the answer is we shouldn't. And we've been doing impact investing and taking impact into account for our whole life. And now we start to have the academic sort of framework to try and make sure we measure what we do and that we go faster in that road. No? We look at impact of how we operate. And this is very important, particularly in Spain. We have some debate about making sure that banks stay in little towns where particularly senior citizens are living, and when a bank leaves one of these towns, obviously there's significant collateral damage. We made a commitment 7 years ago that we would not be leaving any town where we were the sole provider of financial services. That meant that 6 years ago we were the sole bank in 190 towns, together with the sole bank in 483 towns, because unfortunately other banks are obviously more on that mode of retreating. We have increased the number of mobile branches that we use, basically buses with an ATM and one bank teller that goes through various little towns in Spain. We now go through 636. It's an increase for 423 a couple of years ago. And this is allowing us to provide financial services in their town to over 300,000 people, usually senior citizens. Again, obviously making sure that within our commitment to financial health and inclusion, that we actually are present where we need to be. We have been opening what we call social accounts for vulnerable customers, basically exempt from fees for all sort of basic transaction services. We have 390,000 of those now, which is the majority of these kind of accounts that we have in Spain. Made a big push for retirement, thinking of our origin and what's financial health. As we have over 1 million customers that are saving monthly for retirement. November last year we launched a new product, we call it My Box Retirement, My Box Jubilación. We have already 158,000 clients that save small amount, 100 or not so small, depending on the market, 190 euros per month. All that is very important for us, thinking of what we do, what's the impact of what we do, and particularly the impact of what we could stop doing, but obviously would have a negative consequence. A big line is obviously our lending activity, and here we have two things: signatories to net zero. We're now looking at every loan we make to a mid or large corporation, looking at what's the risk, what's the reward, what's the return on risk that we have, but also what is the impact, making sure that we get to be net zero in our scope 3. We have been net zero for scope 1 and 2 now for 4 years. But obviously the target is to be net zero in scope 3 by 2050, and we have published targets for reduction of emissions for our clients by 2030, and now we're actually being able to measure it. Sometimes it's not perfect, as we heard previously, but it's a completely different system. We now think of 3 dimensions when we actually grant a loan, particularly for those of certain size, but this is obviously every single year it goes to a lower and lower level, so that eventually our production is, from the climate point of view, net zero. And we are on good track there. We have microbank, largest microbank in Europe. On the social side, we've estimated to have created over 300,000 jobs, and we have targets now to make sure that we keep creating these jobs every year, so impact is turning into targets. And then finally, obviously the way we invest our money, we are a large asset manager. Juan is the chairman of our asset management here. We're a large insurance company. How do we advise our clients in terms of presenting them sustainable alternatives sustainable alternatives. Article 9, 3 billion in Spain, liquid, illiquid. Obviously, we're trying to maximize the scope of what we do. But certainly, it's a very different mindset from what there used to be. And we know and are conscious of there's a lot to be done, and being able to measure will allow us to be able to manage, which is what we're trying to do. But while we do not have perfect measurement, what it's clear is that we need to get the ball rolling, and that's what we're doing.
Fantastic. Thank you. So, Agnes, coming to you, and thank you for overcoming all the travel challenges like Alison and getting here from the US. Very glad to have you here with us. So we've heard that from Gonzalo how there's a change of mindset which is changing the policies of banking today. Can we say the same about government-backed development organizations like your own?
I think absolutely. So for those of you, first of all, thank you very much for this amazing opportunity to address such an amazing crowd of really people who are doing the most important work in capitalism. So incredibly grateful for this opportunity. For those of you who don't know the U.S. International Development Finance Corporation, we are the U.S. government's development finance institution. And we were created about 3 years ago with a new modernized mission of delivering, first of all, of advancing U.S. foreign policy, but also delivering development impact. So we are very much focused solely on working in emerging markets and developing countries on delivering development impact which benefits those communities. So our entire mission is really focused on that, and therefore we are probably one of the largest impact investors around. What's really important to know about us is that we're incredibly flexible. We deliver tools from anything from equity to guarantees to debt. And we also invest, we can invest as little as $1 million as much as $1 billion. So you can imagine in a lot of these conversations, because of our impact focus, we're really the elephant in the room. But I feel like we're the good elephant in the room, trying to really drive the conversation forward, investment forward, because one of our main objectives is actually to catalyze private capital. So I think what's important there is that we do have tools that enable us to, first of all, make sure that all of our investments are really transparent and adhere to very high social and environmental standards, and that are also enabling our clients to assess and address their climate risks. So I feel that this lens of impact measurement, of climate risk assessment, of environmental and social risk assessment and addressing those risks is really what helps us mobilize much more private capital, who I totally agree with Alison, there is an increased interest in how do large asset managers, how do investors really try to find investable products and an investable pipeline. And I feel that co-investing with us allows them to start really addressing that need that they have that's coming from their own shareholders and constituents. And we have been fairly successful at this. For example, this year we broke through our $1 billion pledge to invest $1 billion in food security. And we've made another pledge to double that by 2026. Through this work, we've supported 9 million smallholder farmers in emerging markets, and actually mostly in lower and lower middle income countries, which I think is really important as well, because many investors feel that those are the markets that really don't present a lot of investable opportunities, especially with an impact focus. So I think we've been able to very clearly show that it is possible to invest in what are seen as difficult markets with impact. And it's really also possible to do it in a transparent and accountable way, which I think is something that a lot of investors, especially investors coming from the developed world, are very much looking for. I think that it's an amazing opportunity that we cannot do without partnerships with the private sector. We only invest into the private sector, and we only support private sector companies. So for the private sector first, to create opportunities in those emerging markets and developing economies for us to bring capital into, and second, for investors to start recognizing that investing alongside with us and with other institutions, with other G7 DFIs, with other banks that are really very much focused on this is the way to really be able to expand their own exposure and their own capital allocation to impact investing.
Can you just remind us what your total assets under management are and how much you invest a year?
Yes, so we currently have $40 billion under management, and we have a total investment cap of $60 billion, so we still have $20 billion to go. Last year, we invested $7 billion, primarily in areas like food security, energy, agriculture, infrastructure, as well as small business support. Small business support is probably one of the largest buckets that we have. And that was about $7 billion last year, and we're hoping to well exceed that this year.
And are you moving to outcomes-based programs where the financial return depends on the achievement of outcomes?
So what we are doing is we have a scoring mechanism called the impact quotient, which we use to assess the potential impact of an investment, and then we measure that potential impact of that investment over time. We don't have outcome-based products, but we actually support outcome-based bonds. We do so in partnership with others because we feel that that is a very innovative and emerging part of capital products that can be supported. I will mention that not exactly an outcome bond, but this year we funded a debt for nature swap with the government of Ecuador to support conservation in the Galapagos. And the government of Ecuador is actually committing out of the savings that they're realizing from the debt to nature swap, they are committing to put money towards conservation into the Galapagos for decades to come. And as a result of that commitment and that conservation funding flowing to the Galapagos, that the bond investors ended up buying those bonds and relieving some of the debt. So it's a form of outcome-based financing.
Wonderful. As I come to Ibukun, you all know that Nick Hurd has taken over the chair of the GSG, and you'll be hearing from Nick sometime after this panel. You may not know that Ibukun has just been appointed vice chair of the GSG. Many congratulations. Now, Ibukun, you're always vocal in redressing the balance between emerging markets and developed markets. How do you see the role of impact in redressing the imbalance that exists today?
Thank you very much, Ron. And thank you, everyone, for coming to our summit. We're really glad to see all the faces here. When you come from the side of the world that I do, you represent so many lives. And in listening to what all my brilliant colleagues have said, I couldn't help but just think to myself, I live at the reality end of it. I live on the side where the real people, that what we do as an impact community will totally change their story. Those are my people. And when you want to understand why what you do is really important, you need to think about every boat that sinks in the Mediterranean. And you realize why people would leave their homes and their families and go off on a journey to nowhere, not ever being sure whether they'll get there. Those are the people that the impact story is talking about, could possibly have saved. when I saw the pictures of Libya and the over 10,000 or so people that died, I said to myself, there are many people from possibly every African country and Middle Eastern country, Afghanistan, anywhere, emerging markets, that would have died in that disaster that nobody will ever account for because they're in transit, moving from their part of the world where they cannot see their salvation, so to speak, to the part of the world where they think there's salvation. So when you think about the immigration issues, whether in America or in Europe, you realize that part of why we have to deal with that is we have an imbalance that creates a sense of hopelessness in some parts of the world, but also destroys the Western world because you can't not deal with having everybody on your ground. The opportunities are not enough for everyone. And so many professionals get destroyed going to work as nobody in other communities because they cannot see the way out. So in applying, resetting how we apply the world capital into regions of the world where real needs and real lives are at stake, in restructuring how the capital is applied, in taking responsibility for putting more capital at risk, knowing that at the end of it will be real lives that will be transformed. And one thing I can say from being a Nigerian is half the time you realize that there's huge return on risk capital in those markets. It's just at this present moment, it's not adequately measured because it has not been tested enough, nor have we had the courage or the boldness to put enough money there with faith, because that's what it's going to require. Knowing as the chairman of a bank, the former chairman of a bank, that the rules that we apply right now to credit and to capital allocation cannot solve the problem. We have to have new rules, new sense of urgency, and a deliberate and intentional action that says, we need to do this, but these rules don't work. And it has to be a collective action because at the end of the day, the whole world benefits from the ecosystem results that we can achieve if we do this right. In talking about supporting agricultural work across Africa, obviously when you think of over 1.4 billion people, if we don't get our agriculture right, and a lot of smallhold farmers are key, they're a great part of our agricultural project now. If we don't invest in them effectively, we cannot feed our people. And there isn't enough food to move from the rest of the world to us, with all of the climate change issues that's affecting agriculture and everything. If I take my country, for example, and you have 69% of your population is under 40, but over 60% of that population is without work. If we do not redirect capital to create micro, small, and medium enterprise that has the capacity to create jobs and engage right-thinking minds to innovate and solve real problems, then we have a problem because they're all going to be trying to migrate to everywhere else, and our countries will suffer for it. And there are new problems actually being created as well. We train doctors literally for free because education is carried by most of our governments. But once they qualify, their dream is to go to America or Europe or everywhere else. So there are increasingly new problems being created because we have not thought about the whole value chain of impact right now and reorganized the economic model of the world in order to accommodate creating real solutions by reapplying capital to solve that. So yes, is impact a key part of what we need to add into our value chain of money? It's the most important thing right now. Because the world, everything is wrong around the world right now. Politics is wrong. The economy is challenged. A lot of people are emotionally drained And we've just come off a pandemic. And we're all trying. Nobody has all the money in the world to solve their problems right now. But some have more than others. And there's a saying in my country that says, you know, that one rich man in the midst of thousands of poor men, he's a poor man. Because at the end of the day, he'll never be able to spend his wealth at peace. Why? All those other poor men will make his life miserable. Which is why migration is a major problem for America. Because if the whole of South America is challenged, and America looks to them like the only place where there's gold shining, they cannot sit at peace. It's the same for us. Europe cannot rest because Africa is not at rest. Thank you.
Thank you. Thank you very much. So the good news is that financial markets are adapting to the concept of optimizing risk, return, and impact. We started off with green bonds and sustainability bonds, and then we began to get bonds where the return depended on achieving a specific environmental or social target, sustainability-linked bonds, which today are a couple of $100 billion. And the banking system shifted to sustainability-linked loans, which are now over $1 trillion across the world. If you take all together these different categories of bond, we're talking of $4 trillion across the world's financial markets. The bond market is about 100 billion, so it's still a small percentage, 4% of the bond market. But it's come from nowhere over a period of just 4 years in the case of the 1.2 trillion of sustainability-linked bonds and loans. And so if we want systemic change, which is what we've all been saying and what Martin Wolf was saying, the paradigm shift can only come from something that drives systemic change. And so I just want to have a brief conversation, we've only got a minute and a half, about the importance of impact transparency and impact measurement, granular impact measurement. Do you feel it is going to be a watershed between the two paradigms if we get to impact accounting?
I can say a few words about that. I don't want to take up all the time. I believe so. And the reason is that it's really large asset allocators, pension funds, institutional investors, insurance companies that, in my view, move the markets. When they are interested in something or when they're incentivized to do something, that money tends to start trickling down into the system with those same demands and aspirations. So if we have accounting standards at that level that they've adopted, slowly they will put those accounting standards to use across all the investments, whether it be infrastructure, private equity funds, venture capital funds, other things that they're investing into, banks, and there will be a demand for that. I think the challenge, though, will be how do we make sure that all that capital really reaches the types of opportunities and innovation that exists in emerging markets that Ibukun just spoke about. How do we connect the two? And I think that's the role of intermediaries. That's really the role of funds, banks, innovative capital allocators that can really connect that demand that is driven by the accounting standards to the supply, which exists in emerging markets for solving some of these biggest issues locally.
Very briefly, Gonzalo.
I absolutely agree. I think it makes a very big difference to be able to measure properly, and then what you cannot measure, you cannot manage, I believe said Peter Drucker. And everybody will be managing it in a different way, and obviously it needs to be common standards and it needs to be independently reviewed. But this is certainly, it would be a game changer to have proper, and it's something that hopefully it's on its way.
Thank you. Alison?
I would just say that in the absence of the type of substantive regulation that actually forces internalization of these externalities that we've been talking about, what impact valuation accounting will do is lift the veil on that. So it has to be the beginning. It has to be the beginning of, so that we can understand what damages and what opportunities exist that are outside the traditional financial statements. So I do agree, it's quite important.
Thank you. Ibukun, the last word.
What doesn't get measured doesn't get done. It's that simple. So having a measure encourages the bigger guys who need to play to have more confidence in knowing that there can be accountability for their investments.
Thank you very much.
Thank you.
Thank you. That was really great. Thank you.